Good morning, everyone, and thank you for joining June's edition of Blackfinch's 10-minute market forecast. My name is Josh, and I'm the product specialist for our listed investment solutions. And for those of you that are new to the webinar today, we look to explore what's happened over the previous month and consider how current economic conditions could impact markets going forward. And this should hopefully give you some nuggets to take away for your client meetings this week. As always, it's been helpful for you to submit your thoughts prior to the webinar as we can help build effective information together to answer any burning questions that you or your clients may have. So please continue to use that strategic team inbox. But let's get stuck into May. Now, there's been a lot of financial news surrounding changes in economic conditions over recent months and the ever-adjusting expectations for interest rate cuts. And I want to hone in on two regions in particular today. So that's the US versus the UK. And if we go with the US first, so earlier this year, many investors were convinced that the Federal Reserve were on track to reduce interest rates by at least 4 times by the end of 2024. But today, given the higher than expected inflation, we think this level of interest rate cuts are now even more unlikely. And for those investors that are eagerly awaiting that first cut, it might feel like the Fed is cancelling Christmas. But economic data is suggesting that the US economy can handle the higher for longer interest rate environment. The US economy continues to grow at a relatively healthy pace, despite a dramatic rise in the Fed funds rate to its current range of 5.25 to 5.5%, and that's a 23-year high. The resilience of the US economy in the face of these higher interest rates has been one of the biggest surprises over the past 2 years. It wasn't long ago that many investors and economists thought that the US would be heading into a recession. However, there is signs this is slowing. The most recent GDP quarter-on-quarter print came in at about 1.3%, and that missed forecasts by 0.3. There's no question that the Fed's battle against inflation's gone well, but the last mile for them is going to be the hardest. Consumer prices have come down from those lofty highs in June 22, but they still remain significantly above the Fed's 2% target. So going that final mile from 3% down to 2% could be the toughest part of the journey. And I think it's going to take longer than Fed officials expect. And just to explore it a bit more and give an example, core PCE prices came out last week. And as a reminder, that's widely considered the Federal Reserve's preferred inflation gauge. And it looked okay on the surface. It heartened many investors. So it rose 0.2% in April. That was slightly down from the previous 2 months and seemed to be a bit of respite from January's big 0.5% spike. However, supercore inflation, so this is PCE services excluding energy and housing, it paints a different picture. And it's recently become a bit more of a focus because it helps understand the unusual dynamics of housing and rental costs at the moment. And that, in fact, rose 0.3%, which is just confirming some of this stickiness that we've talked about and is an ongoing point to monitor. And we know that the US is the biggest player in the world, but if we just pan out all of this into context, US and global stock markets hit a series of record highs in the first quarter of 24. It's clear that markets in aggregate have been able to overcome the fear that higher interest rates are going to kill that bull market that started early last year. There are some of the more interest rate sensitive fixed income investments that have seen weaker returns as the years progressed and those interest rate expectations have shifted. I'm talking here largely about investment grade bonds or high quality bonds. The more credit driven bond sectors have had a bit of a tailwind, as the underlying earnings and economic growth have surprised to the upside, so that's supportive. And I'm sure many of us as investors at the moment are viewing this current monetary policy by the Fed as very restrictive. But actually, in light of the US's economic and market performance, we might need to consider the possibility that in light of this healthy growth, maybe Fed policy isn't actually that restrictive in relative terms. And maybe that's why they haven't gone into a recession. And now might not even get an interest rate cut this year from the Fed. So rather than it being a negative, the absence of the rate cut this year might just reflect that the economy is doing well and staying invested in the US over the longer term is still a sound investment case, especially with all of the hype behind AI at the moment. And this is going to be a key theme that plays out for the rest of the year. So those economic data prints that we touch on each webinar remain vitally important. And if we jump across the pond and talk all things UK, so the UK's economy bounced back quite strongly from a shallow recession at the end of last year, and it provides some relief for Rishi Sunak, who's struggled to deliver on his promise to revive growth to more respectable levels. The UK economy expanded by a larger than expected rate of 0.6% in the first quarter of 24, and that excitement was feeding into valuations. We saw small and mid-cap stocks outperform large, and the FTSE 250 roughly rose about 4% over the month against the FTSE 100's 1.5%. And the nice run that the FTSE 100 had previously is somewhat given back some of the gains it's made, and it's largely due to the strengthening of the pound as rate cut expectations come into view. But back to the expansion and economic growth, it was services that led the way. But this is the component that's giving the Bank of England the biggest headache on inflation. Wages are still strong, it's creating a strong demand for services, and actually it's the case for global inflation and is what a lot of the developed market central banks are thinking about as well. It's an important trend that we're monitoring currently, but please bear in mind there are still some big base effects to come through that's going to push UK inflation below 2% over the coming months. And it almost feels daft if rate cuts don't come on the cards over the next couple of months at the latest. All eyes are going to be on that second quarterly GDP print, and we're hoping for some stronger expansion than forecast, and that can be supported for a lot of cheaply valued UK companies at the moment, especially for small and mid caps that I mentioned earlier. Also, we had the Bank of England vote to keep its rate at 5.25%. There's no surprise there. But at the same time, they indicated that it could ease policy sooner this month and sooner than what markets actually expect. It was really quite a surprise for many traders because they were thinking another few months to hold on for. Governor Andrew Bailey came out publicly in an address and said that rates may need to be reduced by more than what markets expect, but he emphasised that we need to wait for incoming data. And this has been a key trend over the last month or two. The UK and US have almost traded places. The UK looks ready to cut interest rates, and the Fed picture's become a bit more clouded with this sticky supercore inflation. However, the first to go is the European Central Bank, and this is really widely expected by the markets. There's a 25 basis point cut looking likely on the 6th of June. Obviously, never say never. But it's almost bated breath in the air surrounding central banks at the moment, and it can likely be a catalyst for a number of sectors and asset types. And now then, only a couple dates to look out for. So after the ECB on the 6th, we go over to the US, who are reporting headline and core CPI on the 12th of June, as well as the Fed making their next interest rate decision on the same date. Now, we think the inflation print could be the one that can cause a bit of volatility here, especially if there is an upside surprise. I think markets have pretty much priced in a hold in interest rates from the Fed, and all economic data points to this too. We then have the 20th of June, which is the Bank of England's turn to go on interest rates, and this one's slightly less clear. There's a chance that we could see a cut in June, but many economists are still holding firm and forecasting a month or two more to go. We've already seen momentum shift in UK markets with the recent rally, so a cut would support this rally further. And as we know, a lot of the UK companies are at very, very compelling valuations now. But brilliant, I think it's just on time. So that's everything from us today. So thank you for attending June's webinar. I hope you will have some nuggets to take away for your clients this week. And as always, if you've got any questions off the back of today's content, feel free to contact the dedicator at blackfinch.com, and we'll ensure to get back to you. The next webinar will be held on Tuesday, the 2nd of July, same time, 8:50. And we look forward to seeing you then. So thank you very much. Take care.